Preparing for a financial analyst at Elevance Health interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to be a financial analyst at Elevance Health. I am drawn to financial analysis because I enjoy turning operational data into decisions. My experience with forecasting, variance analysis, and Excel has taught me to investigate drivers rather than simply report results. Elevance Health interests me because healthcare finance directly affects affordability, quality, and access, while the company operates across a complex, integrated model. I would bring analytical discipline, curiosity, and clear communication to help leaders understand performance and allocate resources effectively. While answering, connect your analytical background to healthcare, explain your interest in improving affordability and outcomes, highlight Excel, forecasting, communication, and demonstrate that you understand Elevance Health operates across health benefits, care delivery, and related services. Question 2. What do you know about Elevance Health's business model? Elevance Health primarily provides health benefit plans to commercial, government, and specialty customers, while also operating businesses connected with care delivery and healthcare services. Its economics depend on membership, premium rates, medical utilization, provider costs, administrative expenses, and risk adjustment. I would analyze each business separately because margins and regulatory dynamics differ. The central financial challenge is growing responsibly while managing medical costs and maintaining affordability, quality, and compliance. Make sure to cover Elevance Health's health benefits operations, premiums and membership, medical costs, government and commercial businesses, care delivery capabilities, and the importance of balancing growth, affordability, quality, and regulatory requirements. Question 3. Walk me through the 3 financial statements and how they connect. The income statement measures revenue, expenses, and profit over a period. Net income flows into retained earnings on the balance sheet, while the balance sheet shows assets, liabilities, and equity at a point in time. The cash flow statement reconciles net income to cash through operating, investing, and financing activities. For a health insurer, claims payable and other reserves can materially affect working capital, so I always connect reported earnings with cash generation and balance sheet movements. In your answer, explain income statement profitability, balance sheet resources and obligations, cash flow conversion, retained earnings, working capital, and how insurance-specific items such as claims reserves affect both earnings and cash analysis. Question 4. How would you build a monthly financial forecast for a health benefits business? I would begin with membership by product and geography, then forecast premium revenue using enrollment, pricing, and risk adjustment assumptions. Next, I would model medical costs from utilization, unit cost, provider contracts, seasonality, and known claims trends. Administrative expenses would follow staffing, vendor, and volume drivers. I would reconcile the forecast to historical actuals, document assumptions, run sensitivities, and review variances monthly so the model improves with new experience. Be sure to mention membership, premium yield, medical cost trends, utilization, provider rates, administrative expenses, seasonality, risk adjustment, assumptions governance, actual versus budget review, and sensitivity analysis around uncertain healthcare drivers. Question 5. What is medical loss ratio, and why is it important? Medical loss ratio, or MLR, measures medical claims and qualifying healthcare costs as a percentage of premium revenue. A higher MLR generally means more premium dollars support care, but it can reduce underwriting margin if pricing does not compensate for costs. A lower MLR may improve earnings but could raise affordability or regulatory concerns. I would analyze MLR by product and period, separating utilization, pricing, membership mix, and one-time effects. Focus on the definition of medical loss ratio, medical claims divided by premium revenue, its effect on profitability, regulatory minimums, product differences, quality improvement expenses, and why analysts must interpret movement rather than treat one percentage as universally favorable. Question 6. How would you investigate an unfavorable medical cost variance? I would first quantify the variance by product, market, service category, and month. Then I would separate membership, utilization, unit cost, mix, and timing effects, while checking whether claims are incurred or paid. I would discuss completion factors and emerging claims with actuarial colleagues because recent periods may be immature. Finally, I would determine whether the variance reflects a one-time event, seasonality, or a structural trend requiring revised pricing or forecast assumptions. Make sure to cover separating volume, price, mix, timing, and severity effects, validating claims data, reviewing completion factors, comparing incurred and paid trends, consulting actuarial and operational partners, and determining whether the issue is temporary or structural. Question 7. Explain incurred claims versus paid claims. Paid claims are cash payments made during the period, regardless of when care occurred. Incurred claims represent the cost of services received during the period, including an estimate for claims not yet reported or paid. That estimate is commonly called IBNR. For performance analysis, incurred claims better match medical expense with the related premium, while paid claims help explain cash flow. I would monitor reserve development to assess whether earlier estimates were accurate. In your answer, distinguish service date from payment date, explain incurred but not reported claims, completion factors, reserve development, cash timing, and why incurred claims are more useful for current period profitability analysis than paid claims alone. Question 8. What is risk adjustment, and how can it affect forecasting? Risk adjustment redistributes funds among plans to reflect differences in members' expected healthcare needs. A plan with sicker members may receive additional funding, while a healthier risk pool may contribute. In forecasting, I would model membership risk scores, coding trends, regulatory methodology, and settlement timing separately from base premiums. Because estimates can change, I would show a range and clearly identify risk adjustment movement rather than blending it into ordinary membership or pricing performance. Be sure to mention risk adjustment redistributing funds based on member health status, coding and documentation, product mix, timing, uncertainty, and the need to distinguish operating performance from settlement or estimation changes. Question 9. How would you analyze a revenue variance at Elevance Health? I would build a bridge from budget to actual revenue, separating membership volume, premium rate, product mix, risk adjustment, timing, and other revenue. I would reconcile enrollment and billing reports to the general ledger, then investigate unusual movements with business partners. The key is distinguishing an accounting timing issue from a genuine change in economics. I would quantify the impact on margin and update the forecast if the driver appears persistent. Focus on decomposing revenue into membership, premium rate, product mix, risk adjustment, timing, and other operating revenue, reconciling operational data to the general ledger, and explaining whether the variance changes future expectations. Question 10. What financial metrics would you monitor for a health insurer? I would monitor membership and premium growth, medical loss ratio, administrative expense ratio, operating margin, operating cash flow, claims reserve development, and capital adequacy. I would also review retention, risk adjustment trends, product mix, and service level indicators. No metric stands alone. Rapid membership growth may pressure costs, while a favorable MLR could reflect temporary claims timing. I would use a dashboard with actuals, budget, prior year, and concise explanations for material changes. In your answer, include membership growth, premium revenue, medical loss ratio, administrative expense ratio, operating margin, cash flow, risk-based capital, reserves, retention, and product-level performance, explaining how metrics interact rather than reviewing them independently. Question 11. How do you approach budgeting and variance analysis? I start with operational drivers rather than applying a blanket growth rate. For a health plan, those drivers include enrollment, premium yield, medical utilization, provider rates, staffing, and vendor costs. Each month, I compare actuals with budget and prior year, quantify material variances, identify accountable owners, and distinguish timing from trend. I then recommend an action, such as revising assumptions or controlling spend, and communicate the conclusion in business language. Make sure to cover driver-based budgeting, alignment with strategic objectives, monthly actual versus budget comparisons, materiality thresholds, root cause analysis, ownership, corrective actions, and communicating concise conclusions to non-finance stakeholders. Question 12. Describe an Excel model you have built or would build for this role. I would build a driver-based forecast with separate tabs for historical data, assumptions, calculations, outputs, and checks. Inputs might include membership by product, premium per member, medical cost per member, utilization, and administrative expense. I would use clearly labeled formulas, validation checks, scenario toggles, and sensitivity tables. The output would show an income statement, key ratios, and variance bridges. I would document sources so another analyst can audit and update the model. Be sure to mention model structure, clean inputs, historical data, assumptions, formulas, checks, scenario controls, documentation, sensitivity analysis, and presentation of outputs that help management understand drivers and make decisions. Question 13. How would you evaluate whether a new healthcare product is financially attractive? I would estimate enrollment, premium revenue, medical cost, administrative expense, implementation investment, and required capital over several years. I would test assumptions for utilization, provider pricing, member mix, risk adjustment, and retention. The analysis should show contribution margin, cash needs, break-even timing, and downside cases. I would also consider strategic value, such as improved retention or access, while ensuring the product meets profitability, affordability, regulatory, and capital objectives. Focus on enrollment assumptions, premium pricing, expected medical costs, administrative expenses, implementation investment, risk adjustment, capital requirements, sensitivity cases, break-even timing, and strategic benefits beyond immediate accounting profit. Question 14. What is the difference between generally accepted accounting principles and statutory accounting for an insurer? Generally accepted accounting principles financial statements are designed primarily to present performance and financial position to investors and other users. Statutory accounting is more conservative and emphasizes an insurer's ability to meet policyholder obligations and maintain required capital. Differences can involve asset valuation, reserves, deferred items, and capital treatment. As an analyst, I would avoid comparing the measures mechanically, instead using generally accepted accounting principles for operating performance and statutory information to evaluate solvency and regulatory capacity. In your answer, distinguish generally accepted accounting principles as investor-oriented financial reporting from statutory accounting's solvency focus, explain differences in valuation and capital treatment, and note why analysts should understand both when assessing insurer performance and financial strength. Question 15. How would you assess the quality of a forecast prepared by another analyst? I would first verify source data, period definitions, and reconciliation to reported results. Then I would trace key formulas, assess whether assumptions are supported by historical experience or operating intelligence, and backtest prior forecasts against actuals. I would review sensitivities for enrollment, utilization, pricing, and claims development, and test error checks. Finally, I would evaluate whether outputs are understandable and whether uncertainty is clearly communicated rather than hidden in a single precise estimate. Make sure to cover source data integrity, logical drivers, historical backtesting, reconciliation, assumption support, sensitivity analysis, model controls, reasonableness checks, and whether the forecast communicates uncertainty and ownership clearly. Question 16. Tell me about a time you found an error in financial analysis. In a monthly expense analysis, I noticed a department's costs were unusually low compared with staffing levels. I traced the variance and found that a file had been filtered before the data was uploaded, excluding several invoices. I quantified the impact, informed my manager, corrected the report, and coordinated with the preparer to add a row count and total control check. The experience reinforced that unusual results deserve investigation, even when they initially appear favorable. While answering, use a concise star structure, explain how you detected the issue, quantify the potential impact, show respectful escalation, describe the correction and control added, and emphasize accuracy without blaming another person. Question 17. How do you communicate complex financial results to a non-finance executive? I lead with the answer, then explain the 2 or 3 drivers that matter most. For example, I might say operating margin was below plan by 80 basis points, primarily because higher outpatient utilization outweighed favorable membership growth. I would use a simple bridge, avoid technical jargon, separate temporary timing from recurring trends, and state the recommended action. I would also invite questions and provide supporting detail without overwhelming the executive. Be sure to mention leading with the conclusion, using plain language, quantifying financial impact, separating controllable from uncontrollable drivers, using concise visuals, addressing uncertainty, and ending with recommended actions or decisions. Question 18. How would you prioritize competing requests from senior stakeholders? I would clarify the decision each request supports, its deadline, financial or regulatory impact, and the level of precision required. I would prioritize urgent reporting and high-impact decisions, then estimate effort and identify dependencies. If 2 priorities conflict, I would explain the trade-off to my manager and stakeholders rather than silently missing a deadline. I would provide an interim view when useful, document assumptions, and communicate progress until the final analysis is delivered. In your answer, discuss clarifying decision deadlines, business impact, regulatory or reporting urgency, effort required, dependencies, transparent trade-offs, realistic commitments, and proactive status updates when priorities change. Question 19. What would you do if claims trends suddenly deteriorated after the forecast was finalized? I would validate the data and confirm that the deterioration is not caused by a reporting, eligibility, or claims processing issue. Next, I would examine service categories, geography, product mix, incurred versus paid development, seasonality, utilization, and provider unit cost. I would quantify the impact under base, upside, and downside cases, discuss findings with actuarial and operations teams, and escalate promptly. I would revise the forecast only after distinguishing a durable trend from temporary volatility. Focus on validating data, determining whether deterioration reflects reporting lag, seasonality, mix, coding, utilization, provider pricing, or genuine trend, quantifying exposure, escalating promptly, and updating scenarios without overreacting to one observation. Question 20. Why should we hire you for this financial analyst role? You should hire me because I combine strong financial fundamentals with a practical, questioning mindset. I can build and audit models, explain variances, and translate data into decisions, while staying attentive to detail and deadlines. I am also comfortable partnering with operational and non-finance teams, which matters when medical cost and membership drivers sit outside finance. At Elevance Health, I would bring ownership, integrity, and a willingness to keep improving the forecast and the business insight behind it. Make sure to combine technical skills, healthcare curiosity, attention to detail, business judgment, collaboration, communication, and ownership. Then connect those strengths to helping Elevance Health manage costs, forecast accurately, and make disciplined decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.